everyone, and welcome to Strategic Wealth Strategies with our host, Alan Porter. Alan, how are you? And man, you just bring these experts on that we just aren't able to learn about, especially because of what you bring to the table, where this podcast can really explain things differently than other podcasts involving how to invest your money. Because so many people make the mistakes because they trust their regular financial advisor instead of bringing on all-stars like you bring on.
Well, Neil, I'm doing great, by the way. But, I told you when we first met, I treat my business just like a doctor. I ask question after question, and I expect answers for those questions. I have a team of people I work with, and I don't have those questions answered, and I do some feasibility study or some financial plan, it would be malpractice. But I have certain things that I'm the expert in. But like I said, I team with top CPAs, tax-specific attorneys, and other specialists in their fields like Harlan right here. Harlan was the first one to introduce me to the home equity conversion mortgage. Now, I used to have a mortgage company for several years until 2008 after I retired from the military. But, as you know, some tragic things happened to me and my family, and this is the reason I do what I do. But when Harlan educated me on the home equity conversion mortgage, I just think, I'm talking to myself, why doesn't everybody 62 and older do this? Because I think, what is there, Harlan, $9.2 trillion of home equity for people over 62 or something like this?
Well, that was a couple of years ago. It's now over 11 trillion with the increases of the market. It's the largest asset class in the history of any country in the world.
And people they're not educated. I'm finding this with my life insurance products and my information on guaranteed income. They're not educated. They listen to the old adage of, got a 60-40 stock split, and listen to conventional financial planning. And we think outside the box and keep updated on things. And it's just something that people need to understand, because usually the houses are the largest asset, correct?
In fact, the seminar I was at this past week, the speaker had put together a scenario of net worth, and the housing wealth is now 2/3 of the wealth net worth of people over the age of 62, 2/3, and it's largely ignored.
And it's just sitting there. It's doing nothing for people. And I always tell people, equity in the house is dead equity. It doesn't do anything for you. But you can show people how to take that equity in their house and give them tax-free income every year for the rest of their lives. Or if not, create a legacy for their family will be far greater than what they have in their home.
Well, the fascinating thing is we know this isn't something. One person said to me, well, you sell reverse mortgages, and you're in the mortgage business, so obviously you're going to think that everybody should get one. Just like if you're selling Buicks, you'd want everybody to get one. But it really goes beyond that, because the experts in academia and in the financial planning world have already done the research and published it in the Journal of Financial Planning, and published it in Investment News and all over the place. So one lady came up to me at a conference I was speaking at in Atlanta a couple of weeks ago. And she said, just so you know, I had a table there, and she said, just so you know, I'm not going to come to your seminar because that's the hour that I set aside to do my emails. I said, wow, it kind of hurts my feelings, but why did you cut my hour out? And she said, because you believe that most people over the age of 62 should do a reverse mortgage as soon as they turn 62. And I just don't believe in that. And I said, well, ma'am, this is not a religion that we are teaching. This is math. And if you don't need any faith for this, because it's all facts. So it's not a matter of opinion, but it's been proven that if you start using home equity wisely at the age of 62, which happens to be the 7th principle in Tom Hegna's latest book, who's obviously a kind of a foremost authority on this stuff, and Ed Slott, who I work with, and Dr. Wade Pfau, who's written 3 books on reverse mortgages, Boston College for Retirement Research, the American College, Texas Tech University. The evidence is overwhelming that most people should use a reverse mortgage the day they turn 62, not a few. So, for example, I turned 62 in April. I don't need a reverse mortgage. I can afford to make a mortgage payment. I can afford to pay my house off. But I immediately did a reverse mortgage the day after my 62nd birthday, not because I needed to, but because I wanted to for tax purposes, for net worth, for legacy for my kids. and a number of other reasons. And the interesting thing is that if we take a look at the overall picture of exactly what's going on with the biggest part of most people's wealth, we can change almost anyone's life for the better. Many of them can get by without needing that. So, for example, I need to be in Miami on Wednesday for a conference. I could walk there, I could drive there, or I can fly there. Obviously, the most efficient way I found out is to fly there. And so when it comes to efficient wealth, just like using life insurance contracts, annuities in conjunction with the planning, the same thing applies for properly using our equity. And that's really the function of the way that we work on things in explaining them to clients is, yeah, let's use all of the things that you have. Let's not tie one of your hands behind your back. We can use the whole picture. And we divide that up into the 3 buckets, which I usually use to explain to folks as well.
Well, it's not only the 3 buckets now, because I got a plan that's got 5 buckets in retirement, and the home equity conversion mortgage is just one of the buckets. But it's just that people don't know, and they definitely need to be educated. They need to have an open mind about this stuff, because, like you said, you taught me, you can bridge Social Security gap. Can't take your Social Security until 65, but you want to retire at 62. So use that money from your home equity conversion to bridge that gap, or even better, Social Security. Take it when you're 70, because it grows like what, 8% a year plus cost of living allowance. And there's all other kinds of things you can do. I have people right now, grandparents, that are using this, using the money out to purchase college funding for their grandchildren through life insurance policies.
I'm gonna go back, and I'm gonna question, then I'll let you ask another one. Harlan, is the thing that what are the biggest, I guess, fallacies when it comes to a reverse mortgage? That people say, yeah, I would never do this. This is too much risk, or this is ridiculous. Because I forget who was the first person to talk about reverse mortgages on a commercial. I can't remember the guy's name. I think it was Wilford Brunley or something about reverse mortgages or whatever. Or it was somebody else, some other guy, the guy from MASH, I think it was, that talked about reverse mortgages, but how it just seems like it only is for the person. What are those misnomers out there about a reverse mortgage?
Yeah, that's easy. I've been in this business for 20 years, and there's only 4 of them, and we abbreviate them into an acronym called LIFE, L-I-F-E. The first one is the biggest one. People think for L, they lose their house. They give up their house. They give it to the government. They give it to the mortgage company, whatever. It's just a mortgage. You don't lose it. We put a mortgage on so you can use part of your equity and convert some of your equity to cash. The ownership stays in the name of the client, and the client owns the house, can pass on the house, can sell the house, do everything that you would with a regular 30-year mortgage.
Yeah. That's not explained well on the commercials that they have out there on reverse mortgage.
It's not. Everybody thinks they give up their house and now they don't own it anymore, and they become a renter. But we're lenders. We're not landlords. And people confuse that we want their house for some reason. Banks and mortgage companies do not want houses. That's a failure of the process when we take a house back. We're not interested in foreclosures. We're interested in lending money and collecting interest. That's what our function is. And so it's really weird when people say, you just want my house. And I said, no, we really don't. We have no interest in your house. We don't want to take it over. We're not some sort of shark swimming through the water trying to get it. And the second thing, the I is maybe the second or equal importance, and that's the inheritance factor. Everybody thinks that, one guy said, you're just robbing from my grandkids. And I said, actually, we're doing your grandkids a favor, because I happen to have about 12 life insurance policies and a couple of annuities because I did not pay off my house. So when I die, my kids are not going to get as much equity in my house. They'll still inherit my house, but I will have used a lot of the equity in my house. But they will get a life insurance check tax-free within a month after I die. And we have some second to die policies specifically for inheritance as well. We wouldn't have been able to buy all those life insurance policies if I was busy paying off my house and putting all my money into my house. So it's a trade-off. So when it comes to legacy, very few kids want their parents' houses, but they do like the money and the net worth. And so the inheritance factor is just transferred. And instead of giving my kids the house, they're going to get a life insurance check, whether the market is up or down. They get the same amount that's on the face value of on the death benefit of my policy. And then The third thing is fear. There's a lot of people that they just have irrational fears, like, oh, this is just the way for the government to take my house, and my wife is going to get kicked out when I pass away, and all of these things that aren't true, but people like Dave Ramsey has repeated so many times that you almost believe them. And it's really frustrating because people will come back and say these things, and I'll say, that's actually not true, but do you want to hear the truth? And there was literally an Uber driver that told me that he would never let his mom do a reverse mortgage because that would just screw up his inheritance. And I said, actually, it'll save your inheritance because you won't have to worry about long-term care and you'll save a bunch of money in taxes. And he said, I don't believe that. And I said, I happen to be an expert in this. Do you want a copy of my book? It's not true what you're thinking. And so in a 20-minute ride to the airport, I was able to convince him and at least get him thinking differently. And the fourth thing is expense. People say, oh, this is expensive. Same thing they say about life insurance or annuities. They're expensive. Well, compared to what? A car is expensive compared to a bicycle too, but it is based on what it does. And I have one of these $1,000 cell phones. And I also have one of these $20 rotary dial telephones. And this still can be used, but this is way more effective. So, you get what you pay for. And so is it more expensive? Yes, you have to pay a 2% fee to guarantee that you will never run out of money on the house and you will never get kicked out of your house and you'll never have to make a payment. That's an awesome guarantee. I don't mind paying 2% for that. It's like buying a put on home equity in technical financial terms. So it's a really good deal. So those are the main scenarios, that I'm going to lose the house. My wife's going to get kicked out. They're too expensive. I'm going to rip off my kids, my grandkids, whatever. And those are the things that are simply not true. But it is true that you're going to die with less equity if you do a reverse mortgage. But you'll have more cash in your left pocket. So if I have less equity in my right pocket, I have more cash in my left pocket, and I've got long-term care coverage with my life insurance, and I've got the life insurance policies, and I've got way more cash available than if I would have been busy paying off my house. This dovetails so well, and that's why people like you, Alan, are such a huge advantage to the industry, because you look at a holistic plan rather than the 60-40 bond splits. I was talking to a financial advisor who does the 60-40 bond splits, and I said, how did that work out for you this year? Because he said all of his clients in the 60-40. And he said, yeah, not so good this market cycle.
It's not going to be not so good a couple market cycles. We're going to have to think this way. We're going to have people experts like Alan and yourself to save the people that are really working, and make sure that they can have a tax-free retirement, be able to have money when they retire, or be able to spend it on other things. I think that more and more we're going to see the age population between 60 and older that are going to really be controlling the environment in the entire United States. That's my take, but that's my belief system because of so many people turning 62. It's crazy. It's a number that's so huge, and yet they're the most power in the whole United States. So it's a strange, but these ideas are not brought out. And like Alan coming up with this idea for this podcast, me will put it on my syndication as well. It's just powerful information. So I'm going to go back to you, Alan, with other question. But I wanted to take that because that's what I thought about when I thought about a reverse mortgage. Why the heck would I want to take all the money equity out of my house? Then my house is not going to be worth anything. And that you're saying, well, but selling it, getting real estate agent, doing all these different things, all this stuff, by the time you get the money, it's going to be forever. Now you're getting it. Now you're investing it in other policies. If you really use all your assets wisely and take the biggest asset, your house, and now be able to distribute the money in other ways. Isn't that right, Alan?
Exactly. Just like Harlan just said, how's that 60-40 equity split working out for you? Or in retirement, you got sequence returns risk, but if you got another bucket of money in which to take that money from and let the stock market recover, you eliminate that risk. And this is one of the vehicles that can do that. Cash value life insurance and annuities, fixed index can also. But one of the things that really gets me is I talked to this one guy, lives down the street from me, he has $1 million house, and his house is completely paid for. And I asked him, I said, as an example, I said, let's say they give you a $50,000 or $500,000 line of credit, and they charge you $20,000 for closing costs. He says, yeah, but I don't want to mortgage my house. I said, well, understand this. You still have $480,000 in that line of credit that by law, they have to pay you the same interest rate that they're charging you for a closing cost. So you're arbitraging $460,000 of tax-free money. And he said, oh, that's not possible. I said, well, it is possible. It's an FHA insured loan. And people need to become educated and use it to their betterment and not listen to their financial planners and CPAs that are not educated on these products.
Yeah, that particular client, Alan, we just did one of those, and it was a $400,000 line of credit. He gets a guaranteed increase in his line of credit, had his house paid off. He gets so after closing costs and everything else, he's got a $400,000 line of credit. After the closing costs, he receives guaranteed every single year under the current rates between $25,000 and $30,000 increase. He can pull out $25,000, $30,000 a year and still have 400 grand left.
Wow.
And if his house goes upside down, it doesn't matter because he's got the cash. And his house probably won't go upside down because generally in inflationary times, the house values go up too. A lot of people don't remember what happened from 1980 to 1990 when in a time of very high inflation, house values doubled. And so I'm not saying that's going to happen this time. We can't forecast those things, but whether the house goes up in value or not, he would be guaranteed to have access to that money. And we call it having your cake and leaving it too. So you can have your cake while you're living in your house, and you can still leave it to your kids while you're alive. I had a financial advisor ask me a long time ago, do you want to give your money away with a warm hand or a cold hand? I can give my money away right now to our 4 sons and our 5 grandkids while I'm alive and still live in this house that we bought that happens to be $1 million house forever and never do anything except for paying the taxes and insurance. Now, I'm just a farm kid from Wisconsin who never went to college. If I can figure this out, how come a whole bunch of smart people can't figure this out? It's really kind of basic. You put money into an IRA and you take it out when you get older. You put money into Social Security and you take it out when you get older.
Yeah.
You put money into a savings account and you take it out when you get older. What's wrong with putting money into a house and taking it out when you get older? It's no different.
This is just great. This is great information, Alan. And the thing is, once you get the money, what do you do with it? What's your recommendation, Alan? And then I'll get your recommendation as well, Harlan. But again, Alan's going into the financial end. You're going in, hey, I got you this mortgage, this reverse mortgage. What do you do with the money?
Well, first off, if they fall within the parameters and they're having a hard time of living, and they qualify for the home equity conversion mortgage, that's just a payment that they don't have to make. So it's going to make their retirement much less stressful and giving them a longer lifespan. The other thing too is take that money that you're saving from your house payment, and if you're qualified for it, buy a cash value life insurance. It may not be on you; it may be somebody that's an insurable interest with you. But cash value life insurance, you're paying pennies on the dollar for tens of hundreds, possibly millions of dollars of protection. There's no other financial vehicle out there that will protect the family if you live too long, die too soon, or get sick. And I try to educate people out there. And it's just like Harlan said, I want to give my house to the kids. I said, I had told this one lady in Charlotte, and I said, I want you to call your daughter up right now. She says, her daughter told her, Mom, I don't want your house. You get your house and enjoy it. But I said, people understand. I asked them, I said, do you want your kids to talk to each other after you pass away?
Exactly.
Because if you got 2 or 3 kids, 2 of them may want to keep the house as an investment. The other wants to sell it. And I've got neighbors on both sides of me are basically in the same predicament. But it's the other thing too, Harlan, is they can't recall this line of credit like they used to back in the 1980s, can they?
No, that's this is called non-recourse. The technical term is that that's the technical term, non-recourse. In reality, that means you can never have it taken away, no matter what happens, as long as you're alive in the house and you're paying the taxes and insurance. That's the only requirement to the mortgage, which is a very low bar. Just pay the taxes and insurance, which you'd have to anyway, and live in the house, which you want to live in it anyway. So it can never be taken away. So a lot of people say, I don't need it yet. Everything's just fine. Well, that's what my dad said. And so I said, Dad, put it in place anyhow. And then the little farmhouse in the central Wisconsin, when he had a stroke at 86, because he could no longer get long-term care insurance, when he had a stroke, that money, that little farmhouse had a $300,000 line of credit that had grown over the years that he used for his care. instead of using his IRA money, which would have been a huge tax bill to take it out all in a big chunk when his care was $8,000 to $10,000 a month. So there's really three things or three different listeners in your audience, Neil, and that is the first group has their house paid off, like my dad, and they don't need a mortgage. They don't need money. They're fine. We'll put the line of credit in place so just in case something happens in the future, good or bad. Unfortunately, Dad had to use it for something bad because he had a stroke and he needed it for care. But what if you want to buy a motorhome? What if you want to help your kids buy a house? What if you want to help your grandkids go to college? Whatever.
This is tax-free money. This is the point. It's tax-free money. The difference is if you take out money early, you're going to get penalized. And then if it's depending on the time of the year, if a bad economy, when you wanted to take out the money, you're screwed because you lost 40% of it because of the economy, because of the specific year. So this is a good way to hedge bets against it with the 5 buckets that Alan's talking about. So what do you recommend with the cash? So the cash you get with the line of credit, you use to pay bills, use it specifically enough for if you need it for long term, whatever type of way, use that money, then the line of credit, right?
It's just another it's just another source of income they never had before.
Yes, it's what I'm doing myself personally is the first group of people have their houses paid off. They should just get it set up so that they can use it for income. So they can use it if they're going to buy a boat, use the reverse mortgage to buy the boat. Don't use the IRA money to buy the boat. Because then all the other money will last longer in the IRA or in the cash value life insurance because that bucket is more productive than paying off a 2-3% mortgage. So people that have their house paid off should just create liquidity because otherwise all you can do is brag about your $1 million paid off house, but it's worthless. You can't do anything with it other than live in it. You can't use any of the wealth that you built in it. The second group of people are people like me that either on purpose or by mistake, mine was on purpose, still have a mortgage payment when they hit 62. And that's about 44% of the population that hit 62 are still making a mortgage payment. Well, we can just tell them to stop taking my mortgage payment was almost $3,000 a month. Take that mortgage payment from $3,000 down to 0 and give the $3,000 to Alan. What can Alan do with $3,000 a month if I give it to him instead of paying off my house? A whole bunch of stuff that's way more valuable than paying off a 2.75% 30-year mortgage.
So that's another thing I did not know about reverse mortgages, that if you didn't have your house paid off, you still can get the reverse mortgage at 62. So
exactly.
Is that anybody can? Let's just say, boom, you really are having success later, like Ray Kroc. If someone becomes a Ray Kroc, end up with a $7 million house and they turn 62, can they get a reverse mortgage?
They can. We just did one for a guy that had an $8 million home out in Boston. That's not a home equity conversion mortgage. That's not the FHA mortgage. So it has different sets of rules. It's not available in all states, but it is in most high value states like the Californias and the Texases and the Carolinas and East Coast states. So then they can pull money out as I was just working with a guy in LA that's got a $5 million house, and he's using that money to pay for Roth conversions. To save a whole boatload of money because he's using the house to pay for the Roth conversion instead of his investments to pay for the IRA Roth conversion. That's in group 1 that has their house paid off. But the group 2 people that don't have their house paid off, that's just a cash flow play of eliminating the amount of money that you are sending to the mortgage company, because it's better to send it to Alan's bucket than to send it to the mortgage bucket, because I just got a memo at 62 that I don't have to make my mortgage payment anymore. Why would I continue to make it if there's more efficient places to put it? Yeah. It's just really weird that people keep doing it. They're just stuck into habit. Oh yeah, we got to do it.
So because you're licensed, you're able to talk about this because you don't see these on commercials. So what you're putting on right now on my radio show, plus Alan's podcast, Alan's YouTube channel, is information that no one is able to hear about or watch. Why is that? What is the reason? Well, and that's my last question. We're running out of time.
That's a great question, Neil. The reason why is because it's complicated. Even a very sharp mind like yourself, it takes a half hour to explain it. You can't put that into a minute commercial or a 30-second commercial. It takes a holistic plan of looking at what's going on with your Social Security, what's going on with your investments, what's going on with your Medicare, what's going on with your insurance and your long-term care plan. All of those things have to meld together, and the house has to be just one component. So you need a quarterback like Alan to take this thing and put it together and say, okay, let's look at all these pictures. So Alan won't tell them what kind of mortgage to get. He'll just get our team involved and we'll help with that. I won't tell them what kind of life insurance policy to buy, but I know that Alan knows. So that's the scenario of why it's so difficult to explain, because it's part of an overall process.
Okay. Alan, best place we can find information on you is go where?
Well, you can go to my website, strategicwealth0@gmail.com. And my number is 910-551-1046. Again, that's 910-551-1046. And if I don't answer, because I'm usually on the phone with clients, whatever, just leave a message and I'll get back with you. But this is very, very important to people, and they need to know about it.
Harlan, best place for you?
Best place, you can get a copy of my book for free at fairwayreverse.com, fairwayreverse.com, no dots, dashes, or periods. And you can contact our office at 715-389-8800, 715-389-8800. And we can put you in touch with one of our loan officers anywhere in the country. Now, remember, our loan officers do not sell any other products except for mortgages. So we need to work with Alan on being able to get those things done. But as far as getting a copy of my book for the awareness, we will give that to you for free. And then we have about 4,000 loan officers across the country, 700 offices, so we can help people wherever it is. But start with Alan, start with the quarterback of what's going on there. But certainly I can give the information on the reverse mortgages beforehand.
All right, we appreciate it. It was great information. Thanks again, Harlan. Alan, another great show. That was Strategic Wealth Strategies, guys. Take care.